Hi, everybody. This is Jim Rapon with Coldwell Banker Danforth. This is Seattle Real Estate Chat. And we apologize that we had a little technical difficulty at first, but this will be reposted in its entirety for everyone, as well as links to some of the things we're going to be sharing with you. My co-host, Rhonda, would you like to introduce yourself, Rhonda?
Sure. Thanks, Jim. I'm Rhonda Porter. I'm a licensed loan officer with Mortgage Master Service Corporation, and I'm also author of the blog, The Mortgage Porter.
Mortgage Porter. Wow, sounds like the name of a new boat. But,
yeah.
Okay, and today we're going to be focusing on the TRID new changes and closing statements and how that's being affected by everybody who's doing a new loan across the United States. Everything went into effect October 3rd. And there's some fairly significant changes. Maybe the biggest change is that while all of these things are going on, there was never any kind of a ramp up period or testing period. So everybody's kind of winging it right now. So we're going through that period of uncertainty about, gee, how long does it take, or what happens if this happens? And so for probably the next 2 to 4 weeks, you're going to have a lot of that kind of just working out the kinks. And then my understanding is it's probably going to settle down to be not such a big deal after that. Is that your impression, Rhonda?
I think that's what's going to happen. It's going to take I think it's going to change the entire real estate process, and home buyers and borrowers are going to have to be very proactive with their disclosures, and there needs to be more communication or improved communication of all parties too. And if that happens, then there shouldn't be significant impacts to transactions, but it's going to be last minute changes or surprises that will cause the most significant delays.
Right. Yeah, I've heard probably one of the most concerning things is anything that happens right at the end, when you're right at the settlement table, in terms of changes of any financial data, amount of the loan, amount of the payment, interest rate, change of type of loan, anything that you got to go back to the drawing board. You've got a 3-day window that you have to reset.
Well, it's going to depend, but why don't we start with the loan estimate, and then we can go into the closing disclosure form.
Okay, yeah, we can do this in an organized way.
Yeah.
So would you like me to put up this 3-day disclosure rule thing?
Not yet. Not until closing. Yeah, not until closing.
Well, why don't you jump in and just give us the overview and how you'd like to explain it to us.
All right. Well, first, TRID, as Jim referenced, is an abbreviation for the TILA-RESPA Integrated Disclosure Rule, which is another byproduct of the Dodd-Frank Act, which was a result of the mortgage meltdown. And so these documents TRID has produced are replacing the good faith estimate, which HUD created in 2010, and the truth in lending document, which has been around for quite a while. And so TRID is combining the good faith and truth in lending into one document, which is called the loan estimate. And mortgage people are notorious for abbreviating everything. So you might hear them call it LE instead of GFE, but it's loan estimate. And it's also replacing the HUD-1 settlement statement, which has been around for a very long time, with what is being called the closing disclosure, which Jim referenced both of these documents at the beginning here. So these disclosures went into effect with loan applications as of October 3rd, 2015 and later. So if you have a loan transaction that's in process right now, you're not going to see these documents if your application was dated prior to October 3rd, 2015. You will still have the HUD good faith and the good faith estimate. So so that's kind of like a little bit of a nutshell. And so my plan was to kind of like talk a bit about the loan estimate, which Jim has I think I sent you a link to it too, but I'm not going to go over it line by line because that would be a whole nother show. But what I am going to do is kind of talk about what I think what the most important parts are and what people should know about this document now.
So do you want the document or did you want the link? I'm not sure.
Oh, it's okay. We don't need it. We're not going to go over it line by line. So, but I'll let you know when we talk about the closing disclosure, we can talk about the timeline.
Okay.
Again. So just like the good faith estimate, lenders have to send it once a bona fide application has been triggered. And so the Consumer Financial Protection Bureau has kind of changed what an application is too. There used to be a little bit of wiggle room for lenders where they could say that any additional information they need could possibly they could withhold having an application. But now it's if we've received the buyer's name, the buyer borrower's estimated income, social security number to run the credit report, estimated value of the property or the purchase price, if we know the loan amount, and the property address, we have to issue a loan estimate. And honestly, lenders would probably rather prefer to issue a loan estimate not until we have the bona fide purchase and sell agreement that's been mutually accepted. So we'd rather not have that property address until we get the contract. Borrowers aren't going to be able to shop with this document as it's intended for, because it's going to be originated through a compliance department at a lender, and we have 3 days to deliver it, and especially in the beginning, it's going to take those 3 days possibly to get that document out.
So are you kind of, I'm just trying to get the gist of this because it's so complicated. It sounds like we're looking at a new term that's not like a pre-approval letter anymore, that it's more, you can't really give a full pre-approval letter until after you're at mutual acceptance. Is that right?
No. And there was a lot of miscommunication and confusion about pre-approval letters too that went around in the press. I mean, people were saying we can't issue a pre-approval letter, and that where that came from was because the CFPB says that a lender cannot refuse to give a loan estimate based off of not having third-party verifications, so or documentation. So we can't say we're not going to give you a loan estimate because we don't have a pay stub or we don't have a verification of employment type thing. If a borrower said, "Hey, I make $1 million a year," you know, or whatever, then we have to assume that's the truth and issue the loan estimate. So, and if anything, pre-approvals are more important than ever because we need to be able to help make sure we have an efficient transaction because of these disclosures and the timelines that they trigger and possible delays they trigger. So we can issue a pre-approval, and we can still require documentation for a pre-approval, as we should, but we can't use not having documentation for a reason to not issue a loan estimate. So, and
does that need to be disclosed in whatever you submit? Like when you put together a pre-approval letter, at the bottom it says subject to receiving pay stubs and other documents.
Pre-approval letter is still going to require receiving that documentation, or it's just a pre-qualification. Yeah, okay. or it's just a pre-qual. So that stuff has not changed. That you still have a pre-approval, you still have a pre-qual. But it's just that we can't refuse to issue a loan estimate based off of not having the documentation. Part of the problem is too, is like if we issue a loan estimate without having the documentation, and then we can't use that for a reason to reissue a loan estimate later on. And the reason I think this is so serious is because lenders are liable for some of the fees and charges that once they're disclosed. And so we want to make sure that we have a very, very accurate loan estimate, because we don't want to be on the hook for charges that, and some of them are third-party charges, not even lender fees. It's where it's not one of our charges. It's not a very effective way to do business.
Right.
So once the lender has received all those 6 items I discussed, they are required to issue the loan estimate within 3 days, and then they can be reissued, but only when we have what's called a bona fide change circumstance. So that's going to be things like locking, or if the appraisal comes in with a different value, like a lower value, and it impacts the terms of a loan, or if there's something like there's a change to the sales price, or maybe there's a higher seller credit or something like that we need to possibly redisclose. So, and if a loan estimate is redisclosed, that triggers a 4-day waiting period before a borrower can sign their final loan documents. And that 4-day waiting period isn't that I've emailed a loan application today to the borrower, so the 4 days starts counting then. The 4 days don't start until the borrower has received the documents and we have proof they've received the documents.
So the question that I've heard around this 4-day thing is, this could be triggered by several events, but what about if you're at the end of the period of the buyer's loan lock, and their loan lock lapses and their rate ends up going up? Now, who's gonna have to deal with that? Is it going to be a lender expense, or is it going to be the buyer's stuck. He has nowhere to go. I mean, he had to have the 4 days, and as a result of that, he now is tripped into a much, could be a higher payment that, in theory, could keep them from qualifying.
Well, in those circumstances, it's probably possible to extend the loan unless it's already been extended. And I think the lender is going to look at why was this delayed? You know, did we not get paperwork in time from the borrowers? Was a delay caused because the transaction couldn't close in time? So maybe a delay with the seller, maybe the borrower went out of town or something like that. So if it's not something that's caused by the lender per se, then it's probably not going to be something that the lender is going to pay for, you know, because they're going to be hit with so many other charges because of this new document with the loan estimate.
So it sounds like it'll be treated a little bit like Regulation X when things are waiting to go back and forth.
Well, what'll happen is, like, if the lock is expiring and the rate needs to be extended, that would trigger a new loan estimate and another 4-day waiting period. So the lender is going to have to factor in maybe what would have been a 7-day extension is now a 2-week extension, because we can't issue a closing disclosure until we have all the fees, right? And the closing disclosure has delays for the borrowers too. So so it's really, you know, it's really critical that borrowers and home buyers, when they're in the process, that when they receive their documents, their loan documents, that they review them and acknowledge them. You know, typically it's going to be electronically, would be the fastest way to do this, as soon as possible. So, and that's because it is based off of when they acknowledge it, and we have proof that they've signed it and seen it, not when we deliver. So right. Yeah, I can email something or send something through, you know, e-disclosure. It's not emailed today, but if that borrower doesn't log in and sign their documents for 3 days, then the timeline doesn't start until they log in and do that. So it's and the loan estimate and the closing disclosure cannot be issued on the same day. So if we're going along the transaction, everything, we're right, also almost like near closing, let's say, ready to close, and then we need to reissue a loan estimate because the lock's expiring, like your example, and we're going to re-extend. We have to wait a day before we can issue the closing disclosure. And this is something that is really different in the process, because now, instead of what we had before the closing disclosure was the estimated HUD-1 settlement statement, and that's something that was generated by the escrow company after they received our loan documents and escrow instructions. Now the lender is preparing the closing disclosure. So basically what used to be the HUD-1 for the buyer side. And they'll still work with the escrow company to make sure they have like correct figures and work on a draft. And then that document is delivered to the borrower. And with that, we need to have the borrowers, and I believe it's going to be a wet signature, not something that they can sign electronically. So we'll need like actual ink, and they'll need to get it back to us, and we need proof of when they signed it. And then that will trigger a 3-day wait period before they can sign their final closing papers.
Baloney.
Yeah. And that's like when you have, can I quote you? What did you just say, baloney?
No, I just said baloney. Oh my goodness. I mean, I was just trying to put it all together in my head, and I can't. It's
really complicated. Like when the HUD came, or when the New Good Faith came around in 2010, I understood it, and I was pretty proud of myself. I felt like I was on top of it, and it's taken me months to try to wrap my head around this. And I'm probably foolish for thinking that I'm understanding it. I'm sure something is going to come along and it's going to surprise me again. But it's one thing too is that the you know, it's so the, let me backpedal a little bit. Let's say we have that extension scenario again, because that's very possible to happen, that a lock needs to be extended.
Right.
You know, we really try to lock with enough time, like, and that would be a big tip I would have, is like, you might want to lock for a slightly longer period of time. Like if you have a 30-day closing, you might want to opt for a 45-day lock, because it's only going to cost you slightly more, and then we're not dealing with redisclosures towards the end with a scenario like this. But let's say we have a lock extension. The loan estimate and the closing disclosure cannot be sent out on the same day. So you could send out the loan estimate disclosing that extension fee cost, and then the next day the closing disclosure can go out, and those wait periods, the 4-day wait period with the loan estimate and the 3-day wait period with the closing disclosure, can run simultaneous. So you don't have to wait 4 days and then 3 days to issue the closing disclosure. So, but it's
And
going to
that all can be done electronically. You don't have to have wet signatures for that, right?
not the closing disclosure has to be wet.
Oh, it does.
Yeah,
So,
that's our understanding.
and back to the digital, what is allowed? I heard you say AuthentiSign. Is DocuSign also acceptable? I mean, this is nationwide.
Any electronic signature. We don't. It does,
Okay.
yeah, yeah. And I think like we use Encompass, and I think that LMA has their own
Okay.
electronic signature process.
Okay.
So, and the word that you're going to hear for signing, or what this is all based off of, is they call it consummation. So, is the word. So, it's and the one thing that is nice about the closing disclosure is that it does look similar to the loan estimate. It is 5 pages long. And so it gives the home buyer or borrower a chance to review this document. If there are changes or errors that they see in this, it will need to be redrafted, but it will be in the form of the closing disclosure and not the loan estimate. And so that's what's very, very important, that there's more communication than ever, because it's not as simple as before where you could just say, oh, this credit was missed or something like that. Like, we need to have this stuff really nailed down before it gets to closing.
Okay. All right. So would you like to have this other form up here on the screen so you can?
Yeah. So this, right. So this is the, so the form, let's see here. I am not seeing it. It might be, there we go. So this is the 3-day disclosure rule. And what this is showing is it kind of works backwards. Like, if you were wanting to sign, let's say you're closing on a Wednesday. And so typically, like, ideally, not always, but like ideally, that would mean that you'd be signing on Monday. And so with docs coming back to the lender on Tuesday and then recording on Wednesday, you know, and sometimes that all happens in less time. But if you're closing on Wednesday, let's say you're signing on Monday, you would need to get the disclosures sent back to you if you're doing it by courier with a signed receipt, or hand delivered by the Thursday, the preceding Thursday to that Monday. Some lenders are going to opt for mailing the disclosures, and so that would have to be, then that's a 7-day wait. So they would just pop them in the mail the preceding Monday, so a whole week before, and just assume the borrower has received them. So I think it's important to find out from your lender if they are planning on hand delivering or couriering the closing disclosure, or if they're planning on mailing it. Because when you mail the disclosure, it's going out 7 days in advance instead of 3 days in advance for that wait. And you know, it's possible that if they're sending out 7 days in advance, that you may not even have final loan approval yet. So a lot of changes, you know, may be taking place during that time. It's a little bit of risk.
Now, and for remote signing, this gets even more complicated. Let's say the buyer is in Hong Kong or Dubai or something like that, and they have to have a notary there for their signatures. Most of those situations, to get a U.S. notary that's acceptable by the lender as well as escrow, is it's through the consulate, where they have to set an appointment. They can set an appointment up to a couple weeks in advance in most cities, where they then go in and the notary is expecting them, and but they have to have all the documentation with them at that one time. Otherwise, they have to set another appointment and come back a week or two later. So I can see this being a little bit more precarious with remote signings overseas.
Well, with the loan disclosure or the closing disclosure, I don't believe it's notarized. 99% sure it's not notarized. However, they can't sign their loan documents until, depending on how it was sent to them, 3 or 7 days until after they have signed the closing disclosure.
Right.
So,
so setting the appointments for getting a signature might be tough to just you know, figure out how much time you need. I mean, if you're trying to do it in advance, you may hope that you get the disclosures and that timing works, but it might not.
Well, the lender can't prepare the loan documents, final loan documents, until we know the date the closing disclosure was signed, because they can't be dated before then.
Okay. Well, that doesn't make it easier either.
No, it doesn't. It doesn't. And additional delays may happen if there are changes to the APR, changes to the loan program, you know, and hopefully these things should not happen at this point, but I suppose they have or can, or if a prepayment penalty is added. And these guidelines are coming out of the, again, Dodd-Frank and the mortgage meltdown. So, prepayment penalty, I've not seen or heard of one of those in many years. But it is absolutely, critical that that everybody communicates. And like I was saying, like pre-approvals I think are more important than ever, because if we're going to attempt like a 30-day closing, which should still be very possible, we need to have the borrower should be fully approved with all our recent pay stubs, everything ready to go once they're making that offer. And, not having delays on waiting for the inspection if possible, so we can get the appraisal ordered right away. Just the more time that we have to deal with things that come up, and as you mentioned, especially in the first month or so of these new forms, the better it's going to be for everybody.
Okay. Well, I guess that's that. This is all happening to everybody, so we're not alone with this. It sounds like some have already closed. Have you closed any with these yet?
No, not yet. I mean, it just went into effect, like October 3rd, so which was over the weekend, so it was on the 5th. So I have not closed one yet.
I did get a well, I don't know what you call it now, what I thought was a HUD statement on a transaction yesterday, and it looked very different. Very simple. It's like 5 lines, and that's it.
Yeah, it's an improvement. I mean, I know you can't see, but it is definitely an improvement over the 2010 good faith estimate. I think it includes the full purchase price, or payment, which is nice, with taxes and insurance, where the old good faith did not. But the one thing where they really failed, CFPB, shame on you, is that with the title insurance fee. So when a borrower gets their loan estimate, the funds for closing are not going to be accurate, because they really tweaked up how we quote title insurance fees. So not only are we including the owner's policy fees, just like we had to with the 2010 good faith estimate, they've come up with some other calculation with how we're supposed to quote it. So the buyer's policy that they typically pay for, which is the lender's policy, actually, the full policy is quoted instead of the simultaneous issue rate, which is much reduced. And then we're also still quoting the owner's policy too. So it's not going to be accurate. It will be accurate when they get to closing and they get the closing disclosure form. The one good thing too that I should add is that lenders can still provide written rate quotes and estimates like we have been, and those will be accurate and show the actual fees due for closing.
Right. So in cash transactions, most of this stuff doesn't really matter. I mean, there's but I think that the title insurance part kind of does, because the transaction that I got the statement on yesterday was a cash transaction, and I was a little confused at first. I went, well, wait a minute. I know the buyer's policy is technically for the lender, but there's not any reference to any title insurance anywhere on this statement. So I know the seller pays for the owner's policy and that there is insurance there, but it's completely missing from any of the documentation that I got. So anyway, that's okay. I'm learning too. I mean, I felt a little foolish, but the reality is, I guess probably everybody's going through that. So
right. Anyway. Yeah, everybody is. I mean, in some states, like there's going to be some differences with consummation, because consummation in a state like Washington State means signing, and in some states on the East Coast, consummation, signing and closing takes place at the same time, and that's not the case here. So yeah, so it's now with refinances, which I know we mostly talk about purchases, but with the closing disclosure, there's the 3-day wait period of a refinance plus the 3-day right of rescission. So I mean, yeah, so they don't run simultaneous, those wait periods. So that'll be a different.
So that's going to make refinancing a little bit more tricky too.
Right.
Yeah.
Yeah. Keeping me on my toes. I love my job.
You've got it's job security, I guess. I don't know.
Right.
Okay. Well, hey, thanks so much for the detailed explanation of how all this stuff works. I think we're all going to be learning from it over the next few weeks, or if not months. And we may want to revisit this again. But that's that was kind of what we wanted to do today, was just kind of do, in a nutshell, some of the major points of the process. And again, maybe we'll approach it again in our next one. We've been doing these every 2 or 3 weeks now, so tune in again for Seattle Real Estate Chat on Tuesday mornings. And you can see us on Google, hashtag Seattle RE Chat, or look us up there too on Twitter. We announce when we're going to be doing next episodes and everything. If you have any suggestions of topics about marketing or mortgage or real estate sales information that you think would be helpful about Seattle, the general Seattle area, let us know. We'd love to do a topic about that. Anyway, that's all for today. Thanks so much for joining us.
Thank you.
Okay. Hey, bye, everybody.
Bye-bye.